It is April. You are sitting at your kitchen table, tax documents spread everywhere, and you are staring at a number that makes you feel physically sick. You owe the government more money than you expected. Again. And you are sitting there thinking, I worked hard all year. I paid my bills. I saved a little. And somehow, I still owe this much. And the worst part, you know people out there who earn similar money to you, maybe even more, and they seem to owe almost nothing at tax time. And you have always assumed that must be because they have some fancy accountant or some complicated scheme that regular people do not have access to. Here is the thing. That is almost never the reason. The real reason is much simpler, and it is available to you right now, today. Stay right here, because this video is going to change how you think about tax strategy forever. My name is Guy, and I spend way too much time thinking about tax-advantaged investing and how ordinary Americans are unknowingly handing the government thousands of extra dollars every single year that they did not have to give. If you are someone who earns a regular income, pays your taxes, and has never fully understood how to legally shield your money from being taxed, make sure you hit the subscribe button and give this video a thumbs up if this helps you out. It genuinely helps more people find this content, and that is everything to me. All right, let us get into it. Let me start with a number that I think will genuinely surprise you. According to data from the Tax Foundation, the average federal income tax rate for Americans in 2022, the most recent year with full IRS data, was 14.5% across all filers. Now, that might sound manageable on its own, but when you factor in payroll taxes, state income taxes, and sales taxes, the Institute on Taxation and Economic Policy found that middle-income Americans pay around 26% of their total income in taxes across all levels of government. So for someone earning $70,000 a year, that could easily mean $18,000 or more going to taxes annually. That is a car payment. That is a family vacation every month for a year. That is a significant chunk of someone's financial life. Now, here is what most people do not realize. The United States tax code, as complicated and frustrating as it is, actually contains multiple built-in systems that allow ordinary working Americans to legally reduce that number, not through loopholes, not through anything shady, through accounts that the government specifically designed and actively encourages people to use. And most Americans are either not using them at all or massively underusing them. Here is the thing. According to Kiplinger, reporting on Federal Reserve data, over half of American households, 54%, report having no dedicated retirement savings whatsoever. And even among those who do have retirement accounts, the average employee 401k contribution rate in 2024 was just 7.7% of their income, according to Vanguard's How America Saves 2025 report. That gap between what people are contributing and what they are allowed to contribute represents thousands of dollars in missed tax savings every single year. Money that goes straight to the government instead of compounding in your account. This is where it gets really interesting, because the solution to most of this is not complicated. It just requires understanding a few specific types of accounts, how each one works, and which one is right for your situation. So let us build that understanding right now. Before I walk you through each account, I need you to understand something foundational, because once you understand this framework, everything else clicks. When it comes to investments, there are essentially three ways the government can tax you. It can tax you on the money going in, which is what happens with a regular brokerage account. You earn money, pay tax on it, then invest what is left. It can tax you on the growth each year, meaning you owe taxes on dividends, interest, and capital gains as they happen. And it can tax you on the money coming out, meaning when you eventually withdraw your funds, you owe ordinary income tax on what you take. A fully taxable brokerage account hits you in all three places over time. You invest after tax dollars, you pay taxes on growth annually, and any gains you realize are subject to capital gains tax. Tax-advantaged accounts eliminate one or more of those tax events, and depending on which accounts you use, that difference over a 20 or 30-year investing timeline can be enormous. There are two main flavors of tax advantage: pre-tax, sometimes called tax-deferred, and after tax, sometimes called tax-free. With pre-tax accounts, you contribute money before it is taxed, which reduces your taxable income today and you pay tax later when you withdraw. With after-tax or Roth accounts, you contribute money that has already been taxed, but then everything grows completely tax-free and qualified withdrawals in retirement are tax-free too. There is also a third category that most people completely overlook, which actually gives you all three tax benefits at once. I will get to that in a moment. Let us go through the major accounts one by one with the actual numbers. You need to know for 2026, if you have a job that offers a 401k plan and you are not taking full advantage of it, I want you to understand exactly what that is costing you. A 401k is a workplace retirement account where you contribute pre-tax dollars directly from your paycheck. Your contribution reduces your taxable income for the year, dollar for dollar. So if you earn $75,000 and you contribute $10,000 to your 401k, you are only taxed on $65,000 at a 22% federal marginal tax rate. That is $2,200 of tax you did not pay this year. For 2026, the 401k employee contribution limit has increased to $24,500, up from $23,500 in 2025. That is according to the IRS announcement from the 13th of November 2025. If you're aged 50 or older, you can contribute an additional $8,000 as a catch-up contribution, bringing your total to $32,500. And under the Secure 2 Act, if you are between ages 60 and 63 specifically, you can make an even higher catch-up contribution of $11,250, bringing your potential total to $35,750. Now, here is where I need you to pay attention. Most companies that offer 401k plans also offer an employer match. According to Vanguard's 2025 How America Saves report, the most common employer match formula is 50 cents for every dollar you contribute, up to 6% of your salary. That is free money. It is an immediate 50% return on that portion of your contribution before your investments do anything at all. And this is the part that genuinely frustrates me. If your employer offers a 5% match and you are not contributing at least 5%, you are declining part of your own compensation. You negotiated a salary that includes this benefit and you are leaving it uncollected. Now, you might be thinking, what if my employer does not offer a 401k? Or what if I am self-employed? That is where the next accounts come in. The Roth IRA is one of the most genuinely powerful financial tools available to working Americans, and it is also one of the most misunderstood. Here is how it works. You contribute money that you have already paid income tax on. Those contributions grow completely tax-free, and when you retire and take qualified withdrawals, you pay zero tax. Not reduced tax, zero. For 2026, the Roth IRA contribution limit is $7,500. If you are age 50 or older, you can contribute up to $8,600. Those numbers come directly from the IRS and have been confirmed by Fidelity, Charles Schwab, and Vanguard. Now, there are income limits. For single filers, you must have a modified adjusted gross income below $153,000 in 2026 to make a full contribution. The phase-out range runs from $153,000 to $168,000. For married couples filing jointly, the full contribution is available up to $242,000, with the phase-out range running up to $252,000. Here is what most people do not realize about the Roth IRA specifically. Because you have already paid tax on the contributions, you can withdraw the contributions, not the earnings, but the contributions, at any time, at any age, without penalty. That makes it unusually flexible compared to other retirement accounts. And there is a mathematical argument for the Roth that I think is genuinely eye-opening. Let me give you a simple example. Say you are 30 years old in the 22% tax bracket, and you max out a Roth IRA at $7,500 this year. 35 years later, at age 65, assuming an 8% average annual return, that single year's contribution has grown to approximately $108,000. In a regular taxable account, you would owe capital gains tax on the growth. In a traditional pre-tax IRA, you would owe ordinary income tax on the full $108,000 when you withdraw it. In a Roth IRA, the entire $108,000 is yours. You pay nothing. And that is just 1 year's contribution. Imagine 30 or 35 years of maxing it out. The traditional IRA is the pre-tax counterpart to the Roth. Same contribution limits as the Roth IRA. For 2026, that is $7,500 or $8,600 if you are age 50 or older, shared across both account types combined. You cannot put $7,500 into a Roth and $7,500 into a traditional. The $7,500 is your total IRA limit across all personal IRA accounts. With a traditional IRA, contributions may be tax deductible, meaning they reduce your taxable income today and you pay income tax on withdrawals in retirement. Look, the deductibility rules are where it gets a little nuanced. If neither you nor your spouse has access to a workplace retirement plan, your traditional IRA contributions are fully deductible regardless of income. If you or your spouse does have a workplace plan, deductibility phases out at higher incomes. I would encourage you to check the current IRS phase-out ranges for your specific filing status because they are updated annually. The core question between Roth and traditional comes down to one thing. Do you expect to be in a higher tax bracket now or in retirement? If you expect to pay more tax now, take the pre-tax deduction today with the traditional IRA. If you expect to be in a higher bracket in retirement, pay the tax now and let the growth be tax-free with the Roth. This is the part where things get really interesting, and I mean that completely. There is one account type that most people associate only with paying medical bills, but used strategically, it is the only account in the entire US tax code that is simultaneously pre-tax going in, tax-free on growth, and tax-free on qualified withdrawals. The Health Savings Account, or HSA. Here is how it works. If you are enrolled in a qualifying high-deductible health plan, you are eligible to contribute to an HSA. For 2026, the contribution limit is $4,400 for individual coverage and $8,750 for family coverage. If you are 55 or older, you can contribute an additional $1,000. Those figures come directly from IRS Revenue Procedure 2025. Your contributions go in pre-tax or are tax deductible. The money inside the account grows tax-free. And withdrawals for qualified medical expenses, including doctor visits, prescriptions, dental, and vision care, are completely tax-free. That is the triple tax advantage. Now, here's the part that most people have no idea about. At age 65, you can withdraw your HSA funds for any reason, not just medical expenses, without penalty. You simply pay ordinary income tax on non-medical withdrawals, exactly like a traditional IRA. So, in the absolute worst case scenario, your HSA behaves like a traditional IRA after age 65. In the best case, if you save those funds for medical expenses in retirement, you pay zero tax ever. Here is the strategic move that a lot of financially sophisticated people use. They pay their current medical expenses out of pocket, keep the receipts, let their HSA balance invest and compound for decades, and then reimburse themselves tax-free later for all those old medical expenses. There is no time limit on reimbursements from an HSA as long as the expense was incurred after the HSA was opened. The HSA might be the most underutilized tax advantage account available to Americans who qualify for it. If you have access to a high deductible health plan option through your employer or independently, you should at minimum be contributing to it. Now, you might be thinking, all of this sounds great if you work a regular job with a 401k. But what if you are self-employed? What if you freelance, run a small business, or do any kind of independent work? The Simplified Employee Pension IRA, or SEP IRA, was built for exactly that situation. For 2026, the SEP IRA contribution limit is up to 25% of your eligible compensation with a hard maximum of $72,000. That number comes directly from Fidelity and Kiplinger. both citing the official IRS figures for 2026, up from $70,000 in 2025. To put that in perspective, the standard IRA limit for 2026 is $7,500. The SEP IRA allows nearly 10 times that amount for someone with sufficient self-employment income. Contributions are tax-deductible, reducing your self-employment income and therefore your tax bill significantly. There are no annual filing requirements for a SEP IRA. It is one of the simplest retirement plans to set up and maintain. And contributions can be made as late as your business tax filing deadline, including extensions, giving you significant flexibility on timing. If you are earning any amount of self-employment income, even from a side freelance project on top of a regular job, you may be eligible to open a SEP IRA and begin sheltering that income. A tax professional can help you determine your specific allowable contribution based on your net self-employment earnings. Here is what most people do not realize. These accounts are not mutually exclusive. You can, and in many cases should, be using multiple accounts at the same time. If you are a regular employee with a 401k and you meet the Roth IRA income limits, you can contribute the maximum to both in the same year. That is $24,500 into your 401k plus $7,500 into your Roth IRA. A combined $32,000 sheltered from taxes in 2026 across just two accounts. If you also have an HSA eligible health plan, add another $4,400 or $8,750 on top of that. The psychological force working against most people here is what behavioral economists call present bias. The money going into these accounts is real money leaving your take-home pay today, and the brain is very good at making that feel painful. The benefits, those compound returns growing tax-free over decades, are abstract and distant. Your brain heavily discounts future rewards in favor of present ones. It is the same wiring that makes it difficult to save generally. The antidote to present bias in this context is automation. Set up your 401k contributions through payroll so you never see the money. Set up an automatic monthly transfer to your Roth IRA. Set up payroll deductions for your HSA if your employer offers it. Once the system is automated, you adapt to the lower take-home amount within a few months, and the accounts compound without requiring ongoing willpower from you. Here is where I want to leave you. The American tax code is genuinely complicated, and most people interact with it only once a year at tax time when they are already calculating what they owe. But the real tax strategy does not happen in April. It happens throughout the year, in the accounts you open and the contributions you automate. The 401k, the Roth IRA, the traditional IRA, the HSA, and the SEP IRA are not sophisticated tools reserved for wealthy people or people with financial advisors. They are publicly available, clearly defined, and open to any working American who takes the time to understand and use them. You do not need to max out every account immediately. That is not the point. The point is to understand what is available to you, start where you can, and increase your contributions over time as your income grows. Even an extra $100 a month into a Roth IRA invested consistently for 30 years at historical average returns makes a significant difference to the life you are able to live in retirement. So, here is your action step this week. Look at your paycheck, find out if your employer offers a 401k, and whether you are capturing the full employer match. If not, increase your contribution today. That is the highest guaranteed return available to you anywhere. Then, if you are within the Roth IRA income limits, open one if you do not have one, and set up even a small automatic monthly contribution. The account can sit there and grow even while you figure out the bigger picture. These are not complicated moves. They are just moves that most people never make because nobody taught them. You now know. Use it. If this video helped you, please hit the like button and subscribe. I will see you in the next one.